Welcome back. You're watching Stock Watcher this week, and joining me to unpack your stock-related questions this afternoon is Mutooni from Sanlam Investments. Please be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Thank you so much for your time, Roy. It seems that markets are particularly calm, and they actually have been for the last few days, considering the political position that we are in today. Is this a kind of sense of calm and comfort in terms of how things have gone?
Hi, Zinati. Yeah, look, it seems to me that there's a bit of confidence seeping in. If you split up what the market's doing, it's mostly domestic stocks that seem to be moving. So the banks, large industrials, and interest-sensitive stocks, whereas the commodities and rand hedges seem to be selling off. So the rand's also stronger, which is also out of kilter with a stronger dollar, but there's lower yields in the US and we have lower yields here. It just feels that there's something in the domestic environment that's giving people more confidence to buy these domestic stocks, and pretty much go risk on from that perspective. So yes, it's been a trend line, and anyone in resources is probably really struggling at this point in time.
Yeah, quite interesting, because I mean, usually SA Inc. is the one where all the risk is priced in, and you see a huge amount of sell-offs, even in the banking space, but it's actually the opposite today. Let's actually talk about those banks that are firing on. Is this just another point of optimism for the banks? Do you still think they could be cheap even at these levels or not?
So the thing about the banks is they're big, diversified, and liquid, and they tend to be the way most investors would play risk on a risk on beta cycle. From a valuation perspective, they're definitely not demanding. I mean, with the exception of Capitec and First Rank, both of which have their own unique issues. I mean, not issues, but unique advantages. What you're finding is that they're all trading around 1 times book, 1.2 times book, which for the returns that they generate and for the dividend yields and for the outlooks is actually quite cheap. They've sold down like all the other domestic stocks, but I think when investors want to express a positive view on the domestic environment, that's where they'll go.
What about the retailers? Because you see, even retailers where investors were nervous about just a couple of months ago, like Spar, they're also up today. Are the markets just shrugging off, the unique issues that some of these retailers have, where now they're like, okay, it's actually time to nibble because these stocks are undervalued currently?
So if you split it between discretionary retailers and then stocks like ShopRite and Pick and Pay and Spar, the discretionaries, Mr. Price and Foschini, that reported, actually just showing that you can grow margins, you can reduce your inventories. There's a lot that you can do internally, despite the fact that the economy is not growing. And you're seeing them all bringing through earnings, and their valuations are undemanding. Plus, they play into this whole risk-on environment that if I guess all the political stuff is sorted out over the next couple of weeks, the interest rate cycle turns, then maybe you have a bit of an underpin to them from a top-line perspective. When we talk about the others like ShopRite and Spar and Pick and Pay as well, what you're seeing is outside of ShopRite a bit of a self-help trend, and you can see people seeing a path out of the troubles that these stocks have and figuring that maybe they've sold off too much, maybe too much risk is being priced in, maybe this is the time to get in. I mean, for sure, it's a function of do your own research and be very careful, but I think the risk-on environment brings on such sentiments.
Let's zoom into Spar, because it came out with results and a cautionary announcement this week as well. There seems to be a kind of split in how investors see Spar. Some are saying, some are picking it as their stock pick, saying that Spar is actually showing signs of sorting out all these problems that they've had in terms of governance, in terms of their IT issues, in terms of Poland. But others saying that they still need more proof to actually see if the business is sustainable in this kind of competitive landscape. Where are you on that fence?
So I think the way to look at this is what are the moving parts? I think the one that's staring us in the face is the whole issue about the SAP implementation in the KZN environment. What they've done there, it looks like they've pretty much abandoned that and gone through a different route. Then they have the international issues where they have this business that they feel they're going to sell, but they may have to hold on to the debt. And then you come back domestically, you've got the problem, well, not the problem, you have got environment that ShopRite is really, really strong and not letting up, even as inflation comes off. So there's many moving parts to this story, and you have to graduate it. So the first thing you ask yourself is, will they successfully be able to get rid of that international business? If they're able to, that removes a bit of pressure off them because suddenly all you're dealing with is that debt. Then after that, is there a capital raise that's required to sort out this problem? Then after that, how well are you doing in this new competitive environment where Pick n Pay is reinvesting, ShopRite is being aggressive, and the consumer is not particularly strong? So in my view, I think they're on the right path, broadly speaking. You probably have a lot of moving parts that do not give you much certainty. Lots of things have to go right for the investment case to come. So it's well worth watching, is I think as good as it gets.
Yeah. You talk about lots of things having to go right for the investment case to actually come together. On the other side of the spectrum, seeing that everything is going wrong, Goldfields. And it's quite interesting because, when I asked people about, obviously yesterday they took out that announcement that they are revising down guidance at Salaries Norte in Chile, and also obviously that impacts group guidance as well. But then it seems like this is just another one after, the South Deep issues as well. Is this just a never-ending cycle of headwinds where it just seems that operationally Goldfields is not looking good at this point?
Look, execution is everything, but I think to their credit, mining is incredibly complicated and fraught with risk.
Yeah.
When they give guidance, I suppose you assume that they have great confidence in what they're saying, but so many things go wrong. You never know where the next level is when you dig, what you'll find and all of it. And I think that's what keeps happening. When you're doing exploration, when you're doing mine development, the uncertainty is immense. Your inability to know for sure is significant. Yes, people will say other miners have succeeded there, but I think you'll see during these development phases, it's not clear and it's always quite uncertain. So things do go wrong. And I think that's where they find themselves right now. It's just that the gold price is so high, you'd have expected that at this point in time they'd be reaping those benefits, but you're doing a development, you've got costs rising, the market really wants you to deliver. But what tends to happen in mining is things go wrong. And that, I think, is what we're seeing here.
Is this now putting Goldfields on the back foot in terms of investors that want to play the gold price through gold miners?
No, absolutely. Well, the thing is, and I think if you look at where the gold price tends to go, the gold miners tend to underperform because of exact stuff like this and the fact that cost inflation does come through and execution is always a problem. Plus, you have to keep on renewing your resource, which takes you back to the beginning, that you'll explore somewhere, you'll make a few mistakes, you'll spend a bit of money. So no, I think that is par for the course, and that's what you as an investor in a gold mine needs to be able to price in when you're playing that. If it's a gold price you want to play, the reason why you go into a mining company is because you're looking for a leveraged play on the gold price. But that comes with its own set of risks.
All right. Let's go into PPC. There was a question that PPC, when they released a trading statement earlier on in the week, got hammered, but they actually did better. I think they swung from a loss to a profit. And the question is, Why? And does that maybe provide an opportunity for one to get in?
Well, the thing is, they sold their Rwandese business, so they're out of the whole Africa problem now. They've got new management. That cash comes onto the balance sheet. It's not clear what that cash is for. In my mind, they're in such a precarious industry that's so uncertain, they're probably better off holding on to a lot of that cash. But I think maybe the market was uncertain as to whether that cash will be paid out or what they're going to do with it. So that's probably where the difficulty is. I mean, this is a business that's gone through a lot of trouble over the past few years. You're talking about a new management team. Maybe as a level of comfort, market players probably expected them to pay out a little bit, and they haven't clarified that perspective. And that's what tends to happen in a market such as this.
Well, PPC's been going on about how they're waiting for this big government infrastructure spend in the country. Do you think that maybe that could provide some sort of optimism and upside for the company with this government of national unity, or is it just still too early to tell at this point?
So if you look at the key variables, there is one thing we definitely do need is physical investment, infrastructure investment. The country is currently at about 13-14%. To be able to grow in real terms more than 3 or 4%, we have to be up to about 25 to 30% of GDP. So the potential is there. And the budget is there as well. However, from a cement perspective, you've got the problem that there's the imports that come in. You need the projects which have a long lead time to come in, and you need people to execute on them. So it's hope. That hope is long-lived. There's a lot of risks, but what you're seeing right now is insufficient activity to maintain the amount of capacity you have in the country from a cement perspective. So to play that infrastructure, you probably want to play the Robex or WBHO or Roynet, those ones who have current orders that they're executing on and have order books that are visible over the short term. For PPC, I think it will take a bit of time. And also, remember, I think 50% of all cement goes into residential construction. Where interest rates are right now, that's very depressed.
Yeah, and you're actually right, because even in the latest GDP figures, with that contraction that we saw in Q1, construction was one of the hard-hit industries, and they did mention residential buildings as one of the challenges there. Just going back to banks, is Capitec abide current levels to keep over the short to medium term? I mean, you mentioned obviously as much as the banks are cheap, Capitec isn't. But at this time, just looking at this risk-on environment, would you still consider it expensive?
So in a risk-on environment, I think you buy anything that is optically cheap and hope that the rising tide lifts everything. But Capitec is a very unique business. If you adjust for the cash they have on their balance sheet and the operating entity, maybe doesn't look that expensive. They're growing their business banking side. They're growing, the insurance side is also growing as well. They've shown that they have a track record of innovation, understanding their client base, and of entering and disrupting markets. So this isn't one that I would ignore. The thing is, they've had quite a strong rally over the past couple of months, gone from relatively cheap levels to extended levels right now. That doesn't mean that they don't have the earnings base to carry on this valuation. It just means there's other banks that haven't rallied yet, have actually sold off, and whose valuations give you a significantly bigger margin of safety.
Would you be going into platinum at this point, since the platinum stocks have been under pressure? I don't know. How do you feel about platinum at this point, Roy? Because wow, it's never-ending pressure at this point.
Well, that's the thing about commodities. During the boom, you think the boom will never end. During the downturn, you think the downturn will never end. This is all about supply and demand. So the thing is, you need to see deficits build. And for deficits to build, you need to see capacity taken out of the market. you're not seeing that. What you're seeing is production declining and stockpiles being used up. So we're probably early in the cycle. What could change is if internal combustion engines continue to grow in China. So right now China is focusing on hybrids and battery electrics and all of that. But if you have a resurgence in internal combustion engines, which is where most of the platinum group metals are used, then you could see those stockpiles going up a lot, being depleted a lot faster, and then that gives you hope for these companies. But yeah, it's been one-way traffic for the last year or so, for the last couple of years actually.
Yeah, and yeah, some people also being afraid to catch a falling knife. Let's go on to your stock pick for today. Roy, what will it be?
So today I'm looking at Bidcorp yet again. I know you and I have chatted about this before. I think right now everyone's focused on domestic stocks and everyone's focused on what could happen domestically. But I think some of these rand hedges have been sold off quite significantly. Bidcorp today is trading around 400, which is a multiple below what we've seen them trade in a long time. It's about 15 times. This is a solid business with a solid balance sheet that caters for out-of-home eating in developed markets. They've got a solid margin. Their top line is not at risk when we saw their recent trading update, and I think they still have a bit of momentum over the next couple of years. So that's going to be my pick today. I think sometimes you look away from where the herd is and look for opportunities in less desirable places at that point in time.
Oh, yeah, and I see the pressure that has fallen on the stock lately, so maybe a good buying opportunity there. Thank you so much for your time, Roy. Appreciate it. That was Sanlam Investments' Roy Mutooni.